How does the liquidity of the SPEM ETF compare to other ETFs? The liquidity of the SPEM ETF, SPDR Portfolio Emerging Markets ETF, generally falls within the category of moderately liquid compared to other ETFs. Here's a breakdown of factors affecting SPEM's liquidity and how it compares to other types of ETFs. Factors affecting SPEM's liquidity. Underlying holdings. SPEM tracks the SP Emerging BMI Index, which comprises stocks from various emerging markets. The liquidity of these individual stocks can vary. Stocks of large, well-established companies in emerging markets tend to be more liquid than stocks of smaller companies. Trading volume. The daily trading volume of SPEM shares reflects its overall liquidity. A higher trading volume indicates that investors can more easily buy and sell shares at fair prices. Market conditions. Liquidity can also be affected by broader market conditions. During periods of high volatility or market downturns, overall trading activity, including for ETFs like SPEM, might decline. Comparison to other ETFs. Large cap ETFs, ETFs that focus on large, well-established companies in developed markets typically boast the highest liquidity. These ETFs often have very high daily trading volumes, making it easy for investors to enter and exit positions. Sector ETFs, ETFs that concentrate on specific sectors, especially niche sectors, can have lower liquidity compared to SPEM. This is because the underlying holdings might be less widely traded. Small cap ETFs, ETFs that target small cap stocks, even in developed markets, generally exhibit lower liquidity than SPEM. These stocks are often less actively traded, and their prices can be more volatile. Benefits of SPEM's liquidity. The moderate liquidity of SPEM offers a good balance. Compared to some sector or small cap ETFs, investors can typically enter and exit positions in SPEM with relative ease. This liquidity is particularly valuable for investors who might need to adjust their portfolio allocation or sell their shares quickly due to unforeseen circumstances. Potential drawbacks of liquidity. While SPEM is generally liquid, there's always a possibility, especially during volatile market conditions, that bid-ask spreads, the difference between the price investors are willing to pay to buy a share and the price investors are willing to sell a share, widen. This can slightly impact the price investors receive when selling shares. Liquidity considerations for investors. Investors considering SPEM should be aware of its moderate liquidity profile. While it allows for relatively easy buying and selling most of the time, it might not be ideal for those who require the absolute highest level of liquidity. For investors with a shorter-term investment horizon or those who need frequent portfolio adjustments, highly liquid ETFs focused on developed market large-cap stocks might be a better choice. What is the sector allocation of the SPEM ETF? The sector allocation of the SPEM ETF, SPDR Portfolio Emerging Markets ETF, can fluctuate over time as the holdings of the underlying index, SP Emerging BMI Index, are rebalanced periodically. However, to give you a general idea of the current sector breakdown, here's an analysis based on available data, sources like ETF.com, SSGA Fact Sheet. Predominant sectors. Finance. This sector typically represents the largest allocation within SPEM, often exceeding 20% of the total holdings. It includes banks, insurance companies, and other financial institutions operating in emerging markets. Information technology. The technology sector is another significant component of SPEM, often constituting around 10% to 15% of the holdings. This includes companies involved in software development, hardware manufacturing, and internet-related services within emerging economies. Consumer staples. Companies that provide essential goods like food, beverages, and household products are also commonly found in SPEM, potentially comprising 5% to 10% of the ETF. Other notable sectors. Energy minerals. This sector might include companies involved in the exploration, production, and refining of oil, gas, and other minerals crucial for emerging economies, around 5%. Materials. Companies involved in the production of basic materials like metals, chemicals, and construction materials might also be present, potentially constituting around 5% of the holdings. Communication services. Telecommunication companies and other providers of communication infrastructure can also be a part of SPEM, potentially representing around 5% of the allocation. Less represented sectors. Consumer discretionary. Companies dealing with non-essential goods like clothing, automobiles, and entertainment tend to have a lower weighting within SPEM, likely due to the varying levels of discretionary spending power across emerging markets. Utilities. Utility companies that provide essential services like electricity and water might also have a minimal allocation within SPEM. Real estate. Real estate investment trusts, REITs, focused on emerging markets are generally less prevalent within SPEM. Importance of sector allocation. Understanding the sector allocation of SPEM helps investors grasp the overall risk profile and potential drivers of the ETF's performance. Sectors like finance and technology can offer high growth potential, but they can also be more volatile. Conversely, consumer staples might provide more stability, but with potentially lower growth prospects. The sector allocation can also influence how SPEM aligns with an investor's overall portfolio strategy. For example, an investor seeking exposure to technology growth in emerging markets might find SPEM's allocation appealing. What are some alternative ETFs that track similar market segments? If you're looking for alternative ETFs to SPEM, SPDR Portfolio Emerging Markets ETF, that track similar market segments, emerging markets, here are a few options to consider, each with its own unique characteristics. Broad emerging market exposure. iShares Core MSCI Emerging Markets ETF, IEMG. This ETF tracks the MSCI Emerging Markets IMI Index, offering very broad exposure to emerging markets across various sectors and company sizes, large, mid, and small cap. Compared to SPEM's focus on large and mid-cap, IEMG includes a wider range of companies. It boasts a slightly lower expense ratio, around 0.14%, than SPEM. Vanguard FTSE Emerging Markets ETF, VWO. This ETF tracks the FTSE Emerging Markets All-Cap China A Inclusion Index, providing exposure to a wide range of emerging markets, including a significant allocation to China A shares, shares of mainland Chinese companies traded on the Shanghai and Shenzhen stock exchanges. VWO's expense ratio is around 0.11%, slightly lower than SPEM. Region-specific emerging markets. SPDR SP China A Shares ETF, GXC. This ETF specifically targets large and mid-cap companies listed on the Shanghai and Shenzhen stock exchanges in mainland China. It offers concentrated exposure to the rapidly growing Chinese market, but also carries the specific risks associated with that region. GXC's expense ratio is around 0.6%, higher than SPEM. iShares MSCI India ETF, INDA. This ETF focuses on large and mid-cap companies in India. It provides exposure to the Indian economy, which is another significant player in the emerging market landscape. INDA's expense ratio is around 0.68%, higher than SPEM. Other considerations. Expense ratio. As you saw with SPEM, the expense ratio is a crucial factor to consider. While IEMG and VWO offer broader exposure with slightly lower expense ratios, GXC and INDA focus on specific regions, but come with higher fees. Index tracked. the specific index each ETF tracks can influence its holdings and performance. Consider researching the index methodology and weighting strategies before choosing an alternative. Investment strategy: align your choice with your overall investment goals and risk tolerance. Do you prefer broad exposure or a focus on specific regions? Are you comfortable with the potentially higher risk associated with small-cap companies included in some ETFs, like IEMG? Do the alternative ETFs offer any distinct advantages or disadvantages? Yes, the alternative ETFs I mentioned previously, iShares Core MSCI Emerging Markets ETF, IEMG, Vanguard FTSE Emerging Markets ETF, VWO, SPDR SP China A-Shares ETF, GXC, and iShares MSCI India ETF, INDA, all offer distinct advantages and disadvantages compared to SPEM, SPDR Portfolio Emerging Markets ETF. Here's a breakdown of each ETF's key characteristics to help you compare. SPEM, SPDR, Portfolio Emerging Markets ETF. Advantages: low expense ratio, around 0.07%, broad emerging market exposure, excluding South Korea, focus on large and mid-cap companies for potentially lower risk. Disadvantages: exclude South Korea, limited exposure to small-cap companies with higher growth potential, potentially less diversified than some alternatives. iShares Core MSCI Emerging Markets ETF, IEMG. Advantages: very broad exposure to emerging markets across various sectors and company sizes, large, mid, and small cap, potentially higher growth prospects due to small cap inclusion, slightly lower expense ratio than SPEM, around 0.14%. Disadvantages: higher risk due to small cap inclusion, less focus on established large cap companies compared to SPEM. Vanguard FTSE Emerging Markets ETF, VWO. Advantages: broad emerging market exposure with significant allocation to China A-shares, potentially higher growth due to China's weight, expense ratio lower than SPEM, around 0.11%. Disadvantages: higher concentration risk due to significant China exposure, potentially more volatile than SPEM due to China A-shares, less diversification compared to IEMG. SPDR SP China A-Shares ETF, GXC. Advantages: concentrated exposure to the rapidly growing Chinese market, offers the opportunity to benefit from China's economic boom. Disadvantages: very high expense ratio, around 0.6%, compared to other options, significant concentration risk on a single country, potentially higher volatility due to China-specific factors. iShares MSCI India ETF, INDA. Advantages: concentrated exposure to the Indian economy, another major emerging market with high growth potential. Disadvantages: high expense ratio, around 0.68%, compared to SPEM and some alternatives, concentration risk on a single country, potentially more volatile than SPEM. Can a combination of ETFs achieve similar diversification to the SPEM ETF? Yes, a combination of ETFs can achieve similar or even greater diversification compared to the SPEM ETF, SPDR Portfolio Emerging Markets ETF. Here's why and how. Diversification benefits. Diversification is a fundamental principle of investing. It involves spreading your investments across various asset classes and sectors to reduce overall portfolio risk. By not putting all your eggs in one basket, you are less susceptible to the negative performance of any single investment. SPEM's diversification. SPEM offers diversification across various emerging markets by tracking a broad index. However, it excludes South Korea and focuses primarily on large and mid-cap companies. Achieving similar diversification. You can achieve similar diversification to SPEM by combining two ETFs. 1. Broad Emerging Market ETF, an ETF like iShares Core MSCI Emerging Markets ETF, IEMG, or Vanguard FTSE Emerging Markets ETF, VWO, offers exposure to a wider range of emerging markets, including South Korea and potentially small-cap companies, which SPEM lacks. 2. Developed Market ETF, optional, while not strictly necessary for similar diversification to SPEM's emerging market focus, including a developed market ETF like the SPDR SP500 ETF, SPY, can further diversify your portfolio and potentially reduce overall risk. Advantages of combining ETFs. Greater control. By combining ETFs, you can potentially achieve a more customized level of diversification. You can choose the specific ETFs and weightings within your portfolio to align with your investment goals and risk tolerance. Potentially lower expense ratio. Depending on the specific ETFs you choose, you might achieve a similar level of diversification with a lower overall expense ratio compared to SPEM. Disadvantages of combining ETFs. Increased complexity. Managing multiple ETFs requires more research and potentially more rebalancing compared to holding a single ETF like SPEM. Transaction costs. Buying and selling multiple ETFs might incur slightly higher transaction costs compared to holding just SPEM. Overall, combining ETFs can be a powerful strategy to achieve similar or even greater diversification than the SPEM ETF. It offers more control and potentially lower costs, but requires some additional effort in selection and management. How would an actively managed fund compare to the SPEM ETF in terms of risk and return? Actively managed funds and ETFs like SPEM, SPDR Portfolio Emerging Markets ETF, have distinct approaches to investing, leading to potential differences in risk and return. Here's a breakdown of how they compare. SPEM, Passively Managed ETF. Investment strategy. SPEM tracks a specific index, SP Emerging BMI Index. The holdings and their weightings are predetermined by the index, and the ETF simply replicates the index performance. Risk. SPEM's risk profile is largely determined by the underlying index. It offers exposure to the overall risk and return characteristics of the emerging market asset class. Return. SPEM's return is expected to closely match the performance of the SP Emerging BMI Index, minus the expense ratio. Actively managed fund. Investment strategy. An actively managed fund has a fund manager who makes investment decisions based on their research, analysis, and market outlook. The manager can buy and sell securities based on their judgment, aiming to outperform a benchmark index. Risk. The risk profile of an actively managed fund can vary depending on the investment style and holdings chosen by the fund manager. Some actively managed funds might take on more risk by investing in smaller companies or using leverage, borrowing money to invest. Return. The potential return of an actively managed fund can be higher or lower than that of SPEM. The goal of the fund manager is to outperform the benchmark, often a broad emerging market index, after fees. However, achieving consistent outperformance is challenging, and many actively managed funds underperform their benchmarks. Risk-return comparison. Potential for higher returns. Actively managed funds have the potential to generate higher returns than SPEM if the fund manager successfully identifies undervalued assets or capitalizes on market inefficiencies. Higher potential risk. Actively managed funds can also carry higher risk due to the manager's investment decisions. They might invest in smaller, more volatile companies or employ leverage, which can amplify both gains and losses. Fees. Actively managed funds typically charge higher fees compared to passively managed ETFs like SPEM. These fees can eat into potential returns. Choosing between the two. The decision between an actively managed fund and SPEM depends on your investment goals and risk tolerance. For investors seeking lower risk and costs, SPEM offers a good option with its lower expense ratio, diversified exposure, and focus on large and mid-cap companies, which can be less volatile. For investors seeking potential for outperformance, actively managed funds might be appealing if you believe the fund manager has the skill to outperform the market. However, be prepared for potentially higher fees and potentially higher risk. Can investing directly in individual stocks within the SPEM ETF's holdings be considered? Investing directly in individual stocks within the SPEM ETF's holdings, SPDR Portfolio Emerging Markets ETF, can be considered, but it comes with several drawbacks and complexities compared to simply holding the ETF itself. Here's a breakdown of the pros and cons to help you decide. Benefits of investing directly in individual stocks. Potentially higher returns. By picking individual stocks within the SPEM holdings, you have the chance to outperform the overall ETF performance if the chosen stocks outperform the broader market. However, this requires significant research and stock selection skills to achieve consistent outperformance. Greater control. You have complete control over your portfolio composition and can choose specific companies you believe in based on your research and investment thesis. Drawbacks of investing directly in individual stocks. Increased risk. Individual stocks can be significantly more volatile than a diversified ETF, like SPEM. Picking a few stocks increases your concentration risk and exposes you more to the specific company's fortunes. Research requirements. Successful stock picking requires in-depth research on individual companies, their financials, industries, and competitive landscapes. This can be a time-consuming and challenging endeavor. Transaction costs. Buying and selling individual stocks involve transaction fees, which can eat into your returns, especially if you trade frequently. Diversification. By foregoing the ETF, you lose the inherent diversification benefit offered by SPEM. Owning a basket of companies through the ETF helps spread risk and reduces the impact of a single company's underperformance. Tax implications. Trading individual stocks can trigger capital gains taxes on any profits you realize when selling. Carefully consider the tax implications before actively trading individual stocks. SPEM as a diversified basket. SPEM already offers exposure to a basket of companies within emerging markets. This diversification helps mitigate the risk associated with any single company's performance. Alternative. Focus on asset allocation. Instead of focusing on individual stock picking within SPEM, you might consider spending more time on your overall asset allocation strategy. This involves determining the right mix of asset classes, stocks, bonds, cash, within your portfolio based on your risk tolerance and investment goals. Who might consider individual stock picking? Experienced investors with a strong understanding of fundamental and technical analysis and a high risk tolerance might consider this approach. However, even for experienced investors, achieving consistent outperformance through individual stock picking is challenging. That's all the time we have for SPEM today. So, the big question, is SPEM the right pick for you? Well, it depends. If you're looking for a low-cost, diversified way to gain exposure to emerging markets, SPEM can be a great option. However, if you're a seasoned investor with a high-risk tolerance and the time to research individual stocks, then maybe picking specific companies within the SPEM holdings could be an alternative strategy. Remember, we didn't cover everything here. For a deeper dive, check out the links in the description below to resources that compare SPEM to other emerging market ETFs and actively managed funds. And don't forget to leave a comment below and let us know what you think about SPEM. Is it a yes or a no for your portfolio? We love hearing from you.